And to win in this environment, this game, it's a little bit different. For 10 to 12 years, it didn't matter. Rates kept getting better. Pools of money got bigger. So anybody and everyone, you had a 620 score instead of 680. You just paid 5% instead of 4%. It was no big deal. Now that money's just gone. If you want to participate in this opportunity, you just have to learn the rules have changed a little bit.
So Mike, if I'm wanting to get started with real estate investing, this seems like an interesting time to do that. Like, what's going on in the real estate community, and what do people need to know about like the specific things that are happening right now in the world?
Well, I think that's a great point, because there's so much happening, and some fear is creating some opportunities, but it's also pushing some people away from this whole industry. So I think it's like one of the most valuable times to get in real estate investing, because as the Fed, we talked about this before, is tightening everything. Banks are starting to lend less. Lenders are lending you less on a property. We could go through some numbers later, because I want to show you exactly what that means. But as those things happen, there's just better deals out there. There's going to be some really, really good deals where you're going to be able to create the wealth you want, the income you want. So getting into it now, understanding and going through some knowledge-based learning. How do you set up your realtors? Where do you find your deals? How do you calculate your ARV? Getting all that training in over the next 90 days or so, figuring it out is vital, because next year, the year after, if everything keeps going the way it is, there's going to be so many opportunities that were not there before, and there's going to be a smaller pool of investors who can actually take advantage of those.
Tell me how that works. Like if things are tightening up, why does that mean that there will be more opportunities?
For number one, when we look at the money side, from both as an investor and as a consumer, because the consumers are the people who own the homes, who are going to have to give up those homes for a discount. And on the other side, when we're looking at it for money for us to invest, once again, leverage is key to real estate investing. It is why we can make money from nothing. Anybody could do this. Create the generational wealth. When the Fed does what it does, it shrinks the money pool. It shrinks what's available for everyone. So all these lenders, all these banks, we call it they swim upstream. They start lending to the best of the best, and they kind of forget the rest. Banks are being pushed to where they can only lend a portion of what they could before. Investors in the real estate in Wall Street are also doing the same thing. Here's an example. One of the largest private lenders out there, they used to lend on ARV, which means you would get more money from them, more leverage from them to buy deals.
What does ARV stand for?
ARV stands for after repair value. So if you're into real estate investing, you're buying something under market, undervalued, you're putting some money into it, and you're either going to keep it or you're going to sell it. But it's all about buying properties that are undervalued, fixing them up, and creating wealth for yourself, equity. So let's just say, for example, you buy a house for $250, you put $50 into it, and when it's all said and done, it's worth $400 now. So ARV is the 400. It's the number that it's going to be worth after you bring the property up to market.
Gotcha.
Lenders in the past would lend off of a portion of the ARV. So if it's a $400,000 property, they're lending you off the ARV, the $400,000, and let's just say it's 75%. So they could lend you up to $300,000. If you do the math there, that's the $250 purchase, the $50,000 rehab. Typically, the big private lenders always wanted you to have 10% in. So they're going to lend you the $300,000, but it's going to be very close. But now let's look at if they're lending off of LTV instead of ARV.
Oh, what's that? LTV?
LTV is loan to value. So that's the $250 purchase and the $50,000 you're putting in. They don't care what it's going to be worth in the future. So they're basing their loan off of the $300,000, and they're only going to lend 75% of that.
Okay.
On ARV, they were going to lend on $400,000. On LTV, they're only going to lend based on $300,000.
And that's like what it would look, what the property is valued at once it's all fixed up versus right now.
Right now.
Okay.
So in that case, they're going to lend you somewhere between $275,000 and $300,000 when they're going off ARV. In this market, since they're going off of the cost, they're going to probably only lend you up to like $225,000. So as you can see, there's somewhere between a $50,000 and a $75,000 difference on what they're going to lend now. So they're just being tighter. They're lending less money. They're charging a little bit more, and they're lending you less. So what that means is there's a smaller pool of investors, people buying, who could qualify for those deals. So maybe the deal flow stays the same, but there's only 20 or 30% of the investors out there who prepared themselves, who got them in a situation where they could still be buying in this market. So there's just going to be better deals for the people who could buy and buy quickly.
I hear you. So you're saying like they're only going to, as things tighten up, as the Fed continues to tighten things up, there's only going to be money since the banks are swimming upstream, loan providers are swimming upstream. There's only going to be money for the best of the best. But you're saying if you prepare yourself, you do a little bit of your homework, you can be one of those best of the best.
Correct. If you want to create the wealthy income from real estate investing, you have to put a little bit of effort behind it. And those people who do will be rewarded. They will be rewarded when the times are a little bit tougher. When there's fear in the street, that's when most people are running. So some of this will be based on people can't qualify the investors, but some people are just scared to get involved.
Yeah.
And when you buy when the property values are low, even if rates are a little bit higher, because we're all hoping or knowing somewhere in the future rates will come back down a little bit. They're not going to come back to where they were.
Yeah, I'm hoping.
Your values will go back up. So the people who are positioned correctly can take advantage of this, who stay with it, make sure they have some money, because in both cases here, you had to put in more money. So make sure you have some more money available. Make sure you are one of the people who have a good credit score, good business history. You want to be one of those clients that these people are actually going after, the private money, the banks, whoever's still lending money. You want to make sure you are attractive to them because they're going to be a lot pickier than they were just, 6 months ago, 12 months ago.
So like when people are running away, that's actually the time. I don't know, my brain went to this like cheesy superhero metaphor. Like when there's fear in the street, a hero will rise. That's when you can run out and go, that's an opportunity to shine if you can do your work when other people are willing to are wanting to back off because of the rates.
Correct. And rates are going to affect a lot of things, even on the DSCR and the rental side. What we're seeing a lot of is the DSCR ratios, which is they look at a property and say, does it cash flow? Does it break even? A DSCR ratio of 1 means the expenses and the income equal each other. And in the past, most DSCR loans were based on a 1-to-1 ratio. That's all you needed to do to qualify. Now, a lot of them are going to 1.1, which means the properties have to cash flow even more. But layer that on, if you have a 700 or a 680 score, a lot of that ratio is going to be increased from 1 to 1.1 to 1.2, which means, like it or not, what the real world is and the opportunity out there is the people who have the scores that are higher than the average are going to get better deals. And like in the DSCR world, if you have a lower score and then the lender says, well, you have to hit this other threshold, you have to go to 120% or 1.2 to qualify compared to someone who's good credit score has 1.1. It's harder to qualify for transactions. What that means in real world term is typically the same kind of property, the same rates and everything. You're looking at someone who could qualify for maybe a 75% loan can now only qualify for maybe a 66 or 65%. They're going to have to bring in more money. They're going to be paying higher rates because their qualifications are going to be a little bit tougher.
Gotcha.
The people who are set up correctly, when I say set up correctly, they're taking care of their business. It's set up like a business. They're doing some transactions. They have some money to contribute. We've talked about this on other videos too. You have to create this bucket of money. And in this time, it's even more important if you want to create wealth right now to work on your buckets of money. Get the business credit cards. Get the business lines of credit. Work and find real OPM. This happened back in 2008. That's what we had to do. The banks completely cut us off everything. We had to go out and find real people's money. It's out there. People are searching for better returns. You could be their solution.
Yeah, I'm thinking of a lot of the other videos we've done, like to address these things that you've taught me as we've talked. Like if your credit score is really bad, there's the credit score 911 loan. The idea that could help, if your score is not in the place that it needs to be for this. And then there's also leverage, using other people's money. These are the buckets you're talking about, right? And then, of course, just having, your own savings if people need that too.
Well, it doesn't matter where the money comes from. I mean, our whole goal...
So counterintuitive for me.
Yeah. Our whole goal through this is to set our clients up to win. And to win in this environment, this game, it's a little bit different. For 10 to 12 years... it didn't matter. Rates kept getting better. Pools of money got bigger. So anybody and everyone, you had a 620 score instead of 680. You just paid 5% instead of 4%. It was no big deal. Now that money's just gone. If you want to participate in this opportunity, you just have to learn the rules have changed a little bit and just follow them. All these tools, from the 911 loan to helping people find OPM to, even helping people set up with the banks or who's lending. Our whole goal is to make sure investors, especially the smaller investor, keeps growing in this environment. I look back at 2010 when people were buying like crazy, and I was like, oh, that's kind of, it hasn't changed yet that much. And then, 10 years later, those properties are worth 4 or 5 times what they bought them for. I had many people buy 10 properties, maybe at 125. Now they're worth $650. You're worth a few $1,000,000. Rents increased, all those kind of things. You have to buy when everyone else is running, when there's less people competing against you. And to do that, you just have to be set up correctly. Your business has to be set up correctly. You personally, your buckets of money have to be set up because they are going to require more money. The DSCR, they're going to require more money. The fix and flips are going to require more money. And we see this because we're getting calls from people who have had relationships with lenders, have done 50 to 100 transactions. They're calling us now going like, hey, we're just trying to expand and see what other people are lending. That's not what they're doing. They're just kind of being kicked out a little bit, maybe not being able to do as many loans with lenders, so they have to broaden their horizons. And if someone who's just starting out is competing with someone who has 100 homes under their belt, it's going to be tough for them unless they have some other things going for them.
Yeah, unless they're set up well, like you're saying.
Yeah.
How does this tie back to the ARV? Am I saying that right?
Well, that was all showing people that in all the transactions, when we talk about swimming upstream, what that means is they're looking for people with more cash, more money into the properties. When lenders start switching from lending on ARV into loan to value, all they want is more money from you.
Gotcha. So it's indicative of the economic environment, how it's shifting. Okay.
Yep. They want it tight. That's what the Fed wants. That means there's just less money to go around. Before, there was money everywhere. So you could finance 100%. You could do all these fun little things at low rates. So when we talk about lenders moving from ARV to LTV, that's just a way of them saying we want more money from you to make this transaction work. And that just means there's a smaller pool of people out there who are buying because there's less people who have, an extra 75 or 100,000 per deal to put in each deal. Do you have an extra 100 grand to put in each deal?
Oh yeah.
Yeah.
No, I don't.
But you, even starting out, you could get there because there's this whole community, shadow community, whatever, shadow banking, let's call it that. There's more people out there looking to get a better return on their money. And even a lot of people just trying to get money out of banks because banks are starting to get on the watch list and all these other things because people are starting to pull money out. And then with interest rates rising, banks starting to have some issues. So people are looking to put that money somewhere. And it might not always be 100 grand, but it might be 10, 20. That might pay, does your fix-up cost or your down payment. You really have to broaden where you're getting your money and look where you're getting your money sources from because you may need 30% down now. So if you don't have it, there's someone out there who has that kind of money that they're just looking for a secured, better return too.
Yeah, that makes sense. Like it may not be in the best interest of the banks anymore to lend to as many people as they were before. Like you said, they only want the best of the best now.
Yep.
But other people out there that's still a good reason for people to loan out money if they want a good return. Yep. If you have the money and you want to make some money from your money, it's a win-win, really.
And just easy numbers. I mean, if you look at someone who's living on a fixed income or something, they have $100,000 and the bank's going to pay them 5%, which is a lot better than they were. But you as an investor can pay them 10%. They went from $5,000 to $10,000. They just made an extra $5,000 with the same money.
Yeah.
So for them, that's a huge thing. Now they can have a little bit better life. And 10% with no points or anything else like that is pretty good for an investor, especially if it's their gap money or even if it's funding the whole thing. Things have changed. Banking has changed. Lenders has changed. We don't know how long it's going to be, but you should always have control over not worrying if banks are going to lend or not. So broaden your horizons. Start looking at other options out there to fill the money you need to create the wealth you want.
Okay, so what would my game plan be? I know you've mentioned OPM, you've mentioned making sure your credit score is as high as it can be. In order to move forward, I want to go out there, I want to try to do this. What do I need to do about the environment and how to make it happen?
Great question. Number one, understand that things have changed. Don't expect banks and everyone else to just run and throw some money at you. That time has changed for now. It'll come back again. This opportunity is for the people who want to go through this, and it's going to separate and create the wealth for the people who will go through this, like setting everything up correctly. If you're new to the business, it's setting up, like I call it your pillars. Where do you find your properties? Getting as many people as you can to give you properties so you could find the better properties. The better property you find, the better chance you're going to get more money, especially from a private lender or hard money lender, than if you find deals that are, margins are very tight. Get a lot of properties coming through. Understand how to value them. So when you go to a lender, you're sending them and showing them really good deals, and you understand what you're doing. You want a good deal. The lenders want a good deal. The better the deal, the better chance you are to get more financing. Number 2, just set yourself up your business. Make it look like you're serious about this. Not that you're doing it part-time or when you want to. Part-time's all right, but just make sure even if you're doing it part-time, you set it up as a real business. Get your business name and your business accounts and get your business credit card. Set this up so when you go to a bank or a lender, they understand you're serious about it. They're not telling you hey, well, you don't have a company. What do you, bank accounts, all these. Set it up that you're really serious about doing this. Guard your credit. This is the time you have to guard your credit. I know it's not popular, but guard your credit. I keep saying this is the time where the few will make a lot. And if you want to be part of that few, you have to do these certain things. Find a lot of properties, get yourself, your business and everything on, and then start locating the lenders who are actually lending and build a relationship with them. There's so many people over the last 10 years who've shopped around. They've treated lenders like, whatever. The next lender is going to come in. I don't really care if I treat them or, get them everything they want. They learn to treat lenders poorly. They're going to have to learn not to do that because now lenders are looking at 20 deals for one they want to land on. Be the person, be the entity that goes to the top of the pile, not someone who doesn't get their phone calls returned, everything else like that, because they're not treating the lender and the people correctly. Be good to lenders and start locating and finding them. Spend time on all these pillars of finding properties, finding money, and, contractors and everything daily, and you'll be good. And stick with the numbers. Don't worry about what's happening in the fear because it's always lagging. The Fed's been tightening things up for over a year now. Now it's just starting to hit. When it comes out of it, there's still going to be a lag because people are still going to be used to feeling that things are not going well, that there's not a lot of money flowing around. So you have to make sure you just stick to numbers, make sure your numbers are good. Rents are still strong out there. If you can find something that at least breaks even, makes a little bit of money, when rates come back lower, you're going to be able to re-cash flow. And I always say on the other end too, when I'm looking at a consumer, we see properties selling still like crazy if they're in good locations and the work is of quality. The people who don't do quality work, we see it taking them a lot longer to sell, and they're having to drop 10, 20, sometimes even 30% just to break even, just to sell them.
So don't skimp on the front end with the flips.
Yeah,
contractors.
Your buyers out there that pool has shrunk too, because I've mentioned this in other films too, but someone buying a house, a $500,000 house 2 years ago when rates were like 2.75, buying a house now when rates are in the sevens, they go from a $500,000 purchase that they qualify for about $295,000. 2 years ago, I could buy a $500,000 house. Now I can only buy a $295,000. That's all I qualify for. So guess what? There's a lot less people looking at the $500,000 house, and then less people means it has to shine. It has to look good. And that's where the lenders, everyone wants to know that you know your numbers, that you know what you're doing. And it might be even for a year or so, you're just going to make enough money to get by thinking that this is more like a 3, 5, or 10-year vision, because that's when the values will go up. That's when rates will come back down, hopefully. Everyone predicts they'll come back down, not to where they were, but once rates go back down, affordability goes back up. That same person who could afford $500, but now it's $295, rates go down to the fives, maybe now they can afford $400. That means there's a new market out there. Jump in, get this situated like it's a real business. Understand right now, you're going to have to come up with more money. You're going to have to look a little bit better to bankers, to lenders, and just accept that. That's just the way it is. It's going to change again in a few years. Borrowers will have more options again. But right now, when they don't, this is where the opportunity is.
If I'm remembering, the 3 pillars are find a lot of properties, find good properties, and the second one was set up your business in a legit manner where it looks like a real business. And the third was, remind me of the third.
Well, the third in our case is always, make sure you have a good, diverse source of funding. And then you could even add the fourth of, which is contractors and stuff to help fix them up. Find really good properties. Make sure you're set up to do that, and make sure you have a good variety of lenders who could do different things, especially in this market. Because just what we started at before, lenders are lending less. The ARV to the LTV example, the DSCR ratio is going up for people with less credit, which means you have to put more money into each property, or you get less out when you're cash flowing. Rates go up, things just get tougher and tougher. Less people buying means more opportunity for the ones who are.
Awesome. Thanks, Mike. Thanks for the pillars. Thanks for there's a glimmer of hope, I think, in this more restrictive economic environment. But I think, it's empowering to hear that if you set things up right, if you cultivate the right relationships, and if you're doing your numbers, all those things, that there really is a path forward, even in an environment like this.
Yeah. And it's not just for the people who have all the money. You could find the money. You could create it. Like I said, if anybody needs help finding or contacting and talking to people who may have money, private money, reach out to us. We've done this over and over again. It still does not matter where you came from, what you're doing. You can still create a lot of wealth in this market. You just have to understand the rules of the game have changed a little bit. So change with them and profit.
If I wanted to reach out to people and learn how to find lenders and stuff, is that something I could call or look at the website about to
we have some free tools there, some free roadmaps how to do it.
Right.
Like I said, we've done thousands and thousands of transactions with other people's money and have funded hundreds of millions of dollars in deals. So we have some good tools there. But if someone wants to actually walk through it, be coached by it, just reach out to me at Mike at the Cashflow Company, and I'd be glad to help them, because I went through this in 2008 through 2010. Banks cut me completely off as a lender, and I had to find a different route. And the good thing is I found that, and it's growing, and it's easier and easier. So even if right now times are tough, it is great to do. It's even great when money's flowing, because there's nothing easier and better when you have a good relationship with someone who has money, who just wants a better return.
Fantastic.
Thanks,
Mike. Yeah. Good talking to you.